Hello, everybody. It's a couple of minutes past 5:30, so I'll kick off here and start by welcoming you all to today's session, where we're going to try and answer some key questions typically asked by US investors living in the UK. My name is Nathan Pryor. I'm from independent financial planning practice Partners Wealth Management, and we'll also have speakers Brian Dunhill from investment management firm Dunhill Financial, and Helena Turner from tax advisory practice Trowbridge International. Some quick housekeeping items before we kick off. First of all, you will notice at the bottom of your screen, or depending on how you've logged in, you have the chance to ask questions during this session. Please do use the question function rather than just the chat function, because it allows us to identify specific questions easier. Also, please do bear in mind this is an open and public forum, so perhaps keep your personal details to a minimum. Also, please note we are recording today's session, so we'll send it through to you afterwards, and you can watch your favourite bits back as many times as you like. Now, just to kick us off, perhaps I'll start by asking Brian, well, who is a US person?
Oh, that's a great question. I'm going to help dig through all the weeds of this question, and it doesn't just include people that have an accent like mine, because anybody that's a green card holder, even if they've moved out of the United States, still remains a US associated person. Anybody that's resident in the United States has to conform with all the different rules that we're dealing with. So even if you're a British person in the United States, you're a full US person, a green card holder, a US person like myself. And that doesn't matter if you have two passports, you still have to fulfill and complete all these rules that we're going to be talking about.
It's great. And Helena, I guess that rolls on nicely to, well, what are those rules? What do US people who are living here in the UK need to be thinking about?
It's really simple, really. The IRS wants to know about everything. It's a real special club being a US citizen, because there's only 3 countries on the whole of planet Earth that tax on citizenship. US is one of them, and the other 2, in case you get them in a pub quiz, are Eritrea and North Korea. So literally you report your worldwide income, calendar year basis, and the IRS wants a lump of it unless you pay taxes elsewhere, and then maybe you might get some relief for it.
I think that's an important point, isn't it? Maybe. So we'll go into some details there. Talking about pub quiz, thank you for those who answered the poll, and the results have just pinged up to say that 77% of you are up to date with your US tax return. So that's great. Those that haven't, next time, let's hope we're 100%. We'll try and do a couple of polls as we go through. But perhaps as we kick off, I guess probably the most frequent question I get asked and other gets asked is, what exactly a US person living here in the UK can invest in? There's lots of kind of, I guess, misinformation out there about you can't do this or you have to do that. Brian, do you want to have a first stab at answering that for us?
I'd love to. I think what we'll concentrate is why you want to concentrate on certain things instead of what you should be doing. So the first part, we want to make sure everything conforms on the US side of things. This is why we typically only buy US investments, because if we're buying a UK investment vehicle, a UCIT or an ETF on the London Stock Exchange, we'll end up owning what are called PFICs, passive foreign investment companies. Now, Helena, I noticed that you're nodding your head, because owning a PFIC means that you're going to spend a lot of time with your tax accountant. They're going to be cumbersome, potentially costly, and essentially that time-consuming and costly aspect from a tax perspective means that it's going to eat into your potential returns. Whereas if we buy a US listed stock or a US listed exchange traded fund, now all of a sudden we're avoiding all of those PFIC restrictions. So that's why we want to buy on the US exchanges. Now, subsequently, even though the UK is no longer part of Europe, we also want to make sure that we conform with the European rule, the MiFID rule, which essentially there's no punishments for this, but we want to make sure that we're not buying US mutual funds. So anytime you see those 5 letters, it's not to say that there's any punishment at this point in time, but there could be in the future. But anything that's a mutual fund also won't be HMRC qualified, which basically means that you're going to get a better ruling on the UK side of things. The UK side of things, you'll get a 20% tax in the UK if it qualifies for these. And there's only about 90 exchange traded funds that are listed in the United States that meet that HMRC qualifications. But any of the portfolios we design, we make sure to only utilize those. Unless it's in an IRA in the States, we can go beyond that because it's tax deferred. Same thing if you have your SIP or your corporate pension on the UK side, we can bypass some of these rules because there isn't any tax to declare on an annual basis. But if you meet the US, avoiding the PFIC situation, you make sure that you conform with MiFID and you make sure that you're in line with the HMRC, all of a sudden you'll have a portfolio that's optimized for your tax situation and compliant in both jurisdictions.
Brian, you're right. It's a constant balancing exercise, isn't it, between the US and the UK, or the US and the country that you're living in. You don't, if you have a UK advisor and they're not looking at the US side of things, you could be totally compliant and really tax efficient, and then the US comes and blows it all out of the water. So it really is a balancing act between the two.
Absolutely.
And I guess there's sometimes, Brian, is being careful not to let the what sometimes people call the tax tail wag the investment dog, if that's the appropriate phrase. How do you kind of incorporate that into portfolios?
Absolutely. If I had a typical British person coming into our office saying, where should I start putting my money away? We'd start talking ISAs, individual savings accounts. Whereas for an American individual, that's the last place we want to start. It works if we're just building it into a bigger portfolio, but it's not a great starting point because it's great from a UK tax perspective, but we still have to pay US taxes, and we only have a limited scope of things that we can utilize. So what we want to really try to do is we want to try to build somebody's plan into a full financial plan to optimize what goes in, what comes out, and the tax becomes the tail, not the dog. I.e., we want to make sure that we're getting the best investments and the best opportunity to achieve the different goals instead of just filling out the tax optimization, because then all your money might end up in a SIP or an IRA, and you can't touch that until 55 or 59 and a half without severe penalties. So,
Helena, Brian's raised there the kind of big question mark that people often ask of ISAs in the UK. Some people kind of say, no, an ISA is a PFIC, but that's not necessarily true, is it?
No, it's not necessarily true. So, yes, you're right. As a general rule of thumb, anything that's tax-free, tax deferrable, great from a UK tax point of view, not necessarily from a US point of view. Potentially it's reportable and taxable as well. So you've got to think about these things. Cash ISAs, the interest income is taxable on the US return. But let's face it, the interest rates have not been that generous. So percentage tax of not a lot is even less. But you've still got to think about it. It still needs to go on the return. Shares ISAs, you can invest in pure vanilla stocks and shares. You'll get capital gains treatment in the US and the UK. You don't get a capital gains allowance in the US though. And there's other things that you can invest in, the compliant funds as well that Brian was talking about. But also, why not get the family involved as well? So if you're married to a non-US person who says romance is dead, it can be really tax efficient because you can give them a certain amount each year and they can invest it in the non-US stuff. They can go for the ISAs and the PFICs as much as they want. And also maybe from another investment point of view, you've got the potential of lower rate bands in the UK as well. So overall, your tax efficiency could be really great if you get the rest of the family involved as well. But you have to be careful.
Well, I'll jump a little bit further in that because we do have an ISA that's available. The only problem is we can only buy individual stocks for Americans. So therefore, we only have a more aggressive type of portfolio, i.e. growth or aggressive growth. We won't have conservative or moderate portfolios built for those. Hopefully we will be able to in the future, but we just haven't gotten to that area of comfort with building those portfolios. Now, having individual stocks inside of a portfolio isn't horrible. It's just not as diversified as being able to buy a list of exchange traded funds. So if you have somebody that already has a pot of money in other portfolios, that can work out because the overall portfolio is balanced, but we just don't like it as a starting point. Sometimes if somebody has a large cash ISA, we might say, let's take out a piece and put it into a general investment account and then keep the rest inside of the ISA, i.e. we don't mind the volatility of the ISA, but it becomes more tax efficient in the meantime. But going back on Nathan's point, sometimes it's going to be better to not be 100% tax efficient, but to have more of an opportunity of an investment universe rather than only concentrating on, I get this 20,000 pounds that I can put each year into that ISA.
Yeah, and I think Helen, your point there about looking at the big picture is quite important. I mean, a lot of what I do as a financial planner is to try and help people zoom out a little bit from that point of view. And you know, yes, I know that your priority is this one individual piece of investment right now, but if we do zoom out a little bit and look at what else is going on in a retirement account, pensions, etc., you can then allocate the right investments to the right buckets for tax efficiency, for risk deployment, and make sure that blended overall works. And then that works, Brian, with what you were saying there about, well, maybe your ISA does become a pure equity investment because you're balancing out that elsewhere. I'm going to pick up a couple of questions that have just come through on the question function here, related specifically to the HMRC qualified US funds. There's a comment that the HMRC list isn't that easy to use. No, it's not. It's a huge, long spreadsheet. Unfortunately, there is no shortcut to that. There's no alternative place you can go, because actually that list in itself changes quite frequently. So if you're not keeping up with it, you might buy something that was on the list one year, the next year you check and it's no longer there. So you do have to keep up with that list if you are looking at it, and you need to trawl through the list to try and find the funds that are US funds that are on that list. There are a lot of funds from a lot of providers that are named very similarly in the US as in the UK. They are not the same funds, they are different funds, so you need to make sure you identify the right fund there. Perhaps, Cam, is this a nice time to put up our next poll and perhaps see how people are doing in terms of thinking about expatriating?
This will be interesting, actually, because a lot of people, they can get up to date with their tax filings, but then once they realise how invasive the whole tax system is, they're like, just get me out of here now.
Of course, that's been a bit of an issue whilst the embassy's not been running at full flow, hasn't it?
Almost battering down the doors, I think. I don't blame them, to be fair.
Brian, have you had many people talking about expatriating? Is it ever something you would think of doing?
There's constantly people moving around and shifting around, and the reasons become much more interesting over the course of time. So I think in the last 10 years, we went from 7 million American expats abroad to 9 million in the last decade alone. And I can only imagine that when it's everything else, it's the numbers are only growing as well. So.
Yeah, because you can actually be an American without having set foot in America, can't you?
Absolutely. The accidental American story is a fascinating one.
Yeah, indeed. So quite an even split there, isn't it? Almost 50-50 on those who would think about expatriating versus those not. And I think that's probably fairly representative of the broad picture, isn't it? So we've got just a question I've just picked up on the chat here. I'm a Scot, decided to become a US naturalised citizen, but I now live in Scotland for most of the year. Am I an expat? So I understand, probably think there, are you a US expat? Helena, do you want to give a short answer to that?
Say that again. They're a US person that's moved to Scotland. Is that right?
They became a US naturalised person, but now
right. Okay.
Scotland. Yes.
Short answer. Yep. Which means that no matter where they live in the world, whether it's on the top of a mountain or middle of Edinburgh, they're going to be taxable on their worldwide income, and need to file tax returns. Not only that, they may well need to file something called an FBAR as well, which a lot of people forget. A lot of people with US providers aren't even made aware of this. This is quite important because the penalties are quite big. The IRS wants to know everything that you've got stashed offshore. They think that you're hiding it under the bed somewhere. So the FBAR reports the highest balance in any non-US bank account that you have in your own name, joint names with anyone, or that you have signing authority over, like I don't know, the treasurer of a club, your child's bank account, your father's bank account. And the penalties are something like $10,000 a year if you don't file it. But there is an amnesty out there that allows you to get up to date without incurring any penalties. And we're helping a lot of people through that, which is good, actually. So yeah, in short, yes, you're a US person until you give up your citizenship. And if you had a green card, even if it expired, the IRS is still looking for tax returns, because that's got nothing to do with immigration. They're tax only. So if you've got an expired green card, then that could be an issue as well if you're not filing returns.
I think that's a common misconception, isn't it? That the date on my physical card has passed, so I'm no longer a green card holder. I can forget about it. But that's not quite the case, is it?
No, I would actually suggest if you had it for about 6 years and you're thinking of giving it up, then that would be the time to do it, rather than hit the magic 8-year rule, which we could talk about another time.
Very good, very good. Okay, let me see. We've got another question here. So Helena, I'll tell you, why don't we kind of take a segue here and talk about the specific types of forms and tax reporting that people need to be aware of. You've already mentioned there about FBARs, but there's a whole list, isn't there? There's loads of stuff to think about.
Nathan, be careful what you ask, because you just I could go on for weeks about this. Brian, you both know, you both sat through me just getting carried away, so you're gonna have to cut me off at some point. But yeah, they've got a form for everything, basically. In addition to the FBAR, which is separate from the tax return, there's a really similar form called an 8938. I hope everybody's making notes, because they'll ask questions later. And that does a similar thing. It's part of the tax return, and it reports the highest balances. So you have to go through your investments and look at all these balances. And then they get, depending on the type of form, then you've got to look at the relevant exchange rate to use as well. And then if you do have these magic PFIC investments, then there's a form 8621, which basically looks at the type of investment and whether or not you've had any distributions. Potentially there's averaging over the last 3 years. It can get quite complex. And then if you have pensions, there's also there.
Just a quick clarification, that's only on foreign investments, i.e. investments outside of the United States, correct?
That's exactly right. Sorry, yes. Again, I was getting carried away. Only non-US, you're right.
So a nice strategy can be to keep your investment accounts back in the United States, and then you don't have to report it on the 8938. You don't have to report it on your FBAR, because they're US domiciled assets.
That's a really good, really good point there. And then if you're on the remittance basis from a UK tax point of view, then there's no UK tax issue there whatsoever. And that's for your UK advisor to talk to you about. But if you're here for sort of a fairly short space of time, that would be just a really good plan. Just keep it in the US. Exactly right. I could talk to you more about forms if you like.
Let's just pause there for a moment and swerve back towards you know, an important point that Brian just made there. You know, if you're investing in the US, some of these rules don't apply. And one of the questions that have come through is, if I have an IRA, what are the restrictions on investments within that, Brian?
That's it. It's one of those brilliant questions, because there's the letter of the law and then there's how it's applied. Like I was saying, MiFID restrictions very clearly state that we should not be owning accounts that are managed outside of our home countries, i.e. the UK or such. So therefore, a mutual fund in the United States would typically be actively managed, and it would be actively managed from the States. So it doesn't conform to MiFID policies. That being said, the punishment for not conforming to MiFID is nothing. So at this point in time, I would say, if it ain't broke, don't bother fixing it inside of the IRA because of that going on. But I would make sure to keep yourself apprised to the different rule changes and the like, because if the easiest people to tax are the people that don't have a vote, and a lot of us don't have our votes here in the UK, and therefore it's easy to punish us by saying, well, we're going to just go ahead and tax those foreign accounts. We already have a rule there that says you're breaking that rule. Let's just apply it just like the American PFIC rules are. So typically when we're managing clients' assets, we want to make sure that they conform to all three sets of rules, even if there's no punishment in doing so. You're going to find a lot of the mutual funds in the United States will restrict you from buying in foreign jurisdictions, but they'll allow you to continue to hold them. And that's the reason why, is because they know if they're selling them to you when you're a UK resident, that you're not conforming to those MiFID policies. So no big deal for right now, but might be in the future. Not trying to scaremonger, just trying to make you aware.
Actually, on the IRA point of view, people can still contribute for their IRA for last year, can't they? Right the way up to April 15. They can open an IRA and put me in there right up to April 15.
Absolutely. And you can already do this year's contribution, so you can double up and get your $12,000 in, or if you're over 50, you can get up to that $14,000, which is a great benefit. You know, we always get that question, should I go ahead and renounce my US citizenship? Well, here you're getting to double dip. You get to use UK retirement vehicles, you get to use ISA contributions, and you get to make the US IRA contributions. If you have a solo business, you could even potentially do a US solo 401k. So there's a lot of times where it's actually more beneficial for us to be US expats, but we hear a lot of frustration about, how do I get the information? So here you've got three professionals that are giving you all the information and then telling you, how do I double dip and get the benefits of both sides?
Of course, one of the huge benefits in the UK, as you mentioned there, Brian, is UK pensions and tax relief on that. Helena, I'm gonna come back to you on this, because clearly this is going to be a minefield, isn't it?
It can be, but also it could be really, really cool. But I would say that I'm a tax person, so hey. But, so let's pretend that and you guys know all about this, but let's pretend that I'm in an employer pension plan and I'm an American, and my contributions can to the non-US employer plan can be exempted under the treaty, so I don't have to report those contributions made by the employer onto my US return, which is great, which is fine and everything else. But if I'm planning to maybe retire back to the US, or I'm not sure, and I'm paying a lot more UK tax than I am getting as a credit on my US return, I'm going to have carryovers as foreign tax credits each and every year. And then they only last for about 10 years, and then they fall off the end. So what I could do is actually use up my foreign tax credits by taxing those pension contributions made by my employer, and tax the growth as well, and use up all my foreign tax credits as much as I possibly can, so I'm not wasting them with carryovers. And then what I'm doing, so I'm taxing my additional income. There's a US tax charge on it, but I get a credit for my foreign tax credits. So I'm having extra income tax at 0 rate in the US. and I'm building up pre-taxed income in that pension plan. So when I go back to the States, if I've got a pension plan, all the contributions have been taxed in the US already. So my distributions are going to be subject to a much lesser tax than they would have been, which is really cool. And I've used up my foreign tax credits as well. The only downside of this is you need to keep a track of how much you've been taxing each and every year so that you can prove to the IRS, here you go, here's my statement. But all you do is update it each and every year, one line item, here you go, put it in the return. So there's options out there with pensions, and also the investments that you hold in a pension give you so much more freedom as well. No PFIC issues in a pension in the UK. So personal pensions are good things to look at as well.
What about SIPs? You know, technically they're structured as a trust. Does that cause problems?
That's a murky world, that is. Now, you see, there's professional advice that are on two different camps on this. Yes, SIPs are deemed to be trust-based investment vehicles, or no, they're just deemed to be pension plans and that's it. And so there's different ways of reporting it. For those that deem a SIP to be a trust-based investment vehicle or pension trust-based vehicle, then there's a form 3520 and a 3520A that needs to be filed. Those that don't, they're just reported as there's no additional filing. You just pop them on your foreign investments balance forms, FBAR and your 8938, and you deal with the contributions and the growth accordingly. So that's a murky one, that one is.
It is, isn't it? Yes. Brian, we touched on the question mark of where people might retire. And so if we've got an American who's living here in the UK, filing taxes in both jurisdictions, want to invest, but don't know where we're going to retire at the end of the day, how do you translate that into an investment strategy that might be suitable for them?
Well, it's a great question because we're 4 days away from spring starting. So I'm just going to use the sailing analogy. Now, essentially, a lot of times you leave the doors open. You want to make sure that you're going to go towards someplace. Now, if we're going from London to the United States, but we don't know whether we're going to New York or Florida, we might sail straight towards North Carolina and make the decision later on down the road, because we have a few parameters that we need to meet to and a few that we might not need to. So we want to make sure that we're avoiding PFICs, that we have our HMRC compliant, and that we're avoiding any MiFID issues inside of our portfolio. But currency becomes the big question. If you buy into, say, when you're buying into a UK pension, you definitely have a lot more pounds. If you're using our pound-based portfolio, you have more pounds inside of that portfolio. But if you're retiring back to the States, you might want to use our USD line inside of an IRA, but you definitely don't want to use that outside of the IRA, because then it's not going to be HMRC compliant. So we custom build a portfolio that looks like a USD portfolio, but everything's HMRC compliant if you're definitely going back to the US. If you don't know whether you're going back to the US or staying in the UK, or maybe even just coming down here to France. That's where I am this week, sorry. Sorry, not sorry kind of thing. Now, all of a sudden, you might want to have a mix of having a bit of the European-based portfolio, a bit of the GBP portfolio, and all of a sudden tweak that as you get closer, i.e. going towards North Carolina, and either veering north as you get closer if you decide to go to Europe, or veering south and going more towards the GBP portfolio if you decide to go down to the UK. So it's using that mix and match, having those conversations with your advisor, and making sure that you meet those compliance requirements, but that you manage that risk. And that big risk for a lot of us as expats are those currency mixes, as we've seen over the last 10, 15 years. We've had 15 years of the dollar going straight up. And historically, we've seen the dollar go up for 10 to 15 years at a time, and then it goes down for 10 to 15 years at a time. So I'm not calling a top. don't take that away. What I'm saying is, if you're planning for retirement 30, 40 years out, you can't count on the dollar being very expensive at all times, because that's historically not what we've seen.
And I'll just relate this to a question that's come through in relation to the kind of fungibility of US and UK retirement plans. So the question is, can I transfer my US IRA into the UK and roll it into a UK SIP, for example? I guess the same question could be asked the other way round. Unfortunately, the answer to that is no, you can't. They are very different things, and you can't merge them into one. But Brian, I guess you could use that investment analogy you've just spoken about there to kind of say, well, okay, I've got my IRA, but I'm retiring in the UK. But you could structure the portfolio to be kind of more UK-ish than US-ish.
Absolutely. But I'm going to double down, and I'm actually going to come back on that, Nathan, because if you scour through the internet, you will see some providers that will look at combining SIPs into IRAs, or IRAs and SIPs into Maltese pension plans. Now, these Maltese pension plans, you've probably seen this, the two of you, but the audience might not have. They've been around for 10 years. We've always said we don't disagree with it. We just don't want to sit on the other side of the table from the IRS or the HMRC to explain why we would agree with this. So we've always avoided them. Well, now the IRS has come out and said, we don't agree with them, which we've said, phew, like we never touched those, right? Now, while the combining of UK pensions with IRAs and vice versa, there's several companies that are doing them. And I've read through the documents. There's nothing that I'd sit there and say, hey, this is completely wrong, but I would never want to sit on the other side of the IRS's table or the HMRC's table in combining those. So can you find them? Yes. Have we gotten a determination from the IRS and the HMRC? No. Therefore, you're taking them at your own risk that they might come out and say, this is not correct. And when it's my retirement account, I like to be as conservative as possible, because one piece of bad legal advice destroying my retirement is going to make me very, very upset. Sorry to contradict what you just said, Nathan.
No, that's
back around to the same place.
That's fine, but yes, I think we've ended up at the same conclusion one way or another. Very good. So a question here, Helena, for you maybe. If somebody has made a mistake, perhaps they invested in an ISA, they've got some PFIX, and you know, they hadn't realised that was a problem. What next? What should they do?
Well, it depends, really, to be fair. There is a program out there, and this apply. They need to amend their tax returns, really, to be technically correct. Any filings that they haven't made that they should have made, they're not compliant. They've filed a non-compliant tax return, and so an amended return needs to be done. But a lot of people don't even know they have to file US returns, and so we chat with various clients in various sort of having various issues all the time, just like you guys. And when it comes to dealing with the IRS, there is a disclosure program that can really, really help people to either amend their returns or get them up to date with their filings if they're resident outside the US, for no penalties whatsoever. And the penalties can be really, really huge. So it's just a matter of, a lot of people are putting their head in the sand, and people have come to me and goes, well, I've lived in the UK for 30 years and they haven't found me yet. And that used to be the case. The IRS used to be the people who were out there and they weren't filing returns, maybe because they didn't know. But there's something called FATCA now, which you guys must deal with all the time. And it stands for the Foreign Account Tax Compliance Act. I think it came into legislation in March 2010 as part of the HIRE Act. But basically what it is doing is making every single financial institution, including high street banks, report the bank account details of their US account holders to the IRS in one way, shape or form. So the IRS is collating this information and going, oh, there's Joe Bloggs, and you know what? He's got 30 million in the bank and he's not filing a tax return. That's not a very good return on his investment. So there's ways that you can get up to date with not having any penalties, but you need to volunteer yourself to the IRS. If they find you first, then you're going to be exposed to penalties and stuff. But we're helping lots of people get up to date on amending their returns. But coming back to the IRA front that we were talking about before, if somebody's got an IRA and they're coming up and they want to decide, and we're all helping them decide how they're going to take it out, then there's a couple of ways that they can do it, isn't there? There's the lump sum where they could just take out the whole lot out and they'll be subject to US tax on it, or they can have periodic payments, and because of the treaty, the tax is determined by the taxpayer, not the pension plan. So if you take out periodic payments, then if you're in the UK will tax it. But if you take out a lump sum, then the US will tax it, and normally the US is taxing at a lower rate. So when you are coming up to retirement and you're thinking about all these different pieces of the jigsaw to pull in, this is another piece that you need to figure into that overall picture.
See, I want to add a little fun fact. The IRS doesn't expect us all to be perfect at all times. And we all do make mistakes. And to prove that, just in 2015, 1,580 IRS employees got reprimanded for actually misfiling their taxes. So they understand just as well as us. There's your fun fact for the day.
How did you know it? That's amazing. I didn't know that. That's cracking. I'll have to remember that one. Yeah, but it's absolutely right. Especially, I mean, if you're preparing your own return, how can you be expected to know all of this stuff? There's people out there who can help you get through all of this. And a 5-minute phone call to say, yes, you've got an issue or not an issue is not a problem. We're all here to help, basically, aren't we?
Absolutely.
Yeah, no, quite. And I think, you know, just to add on to that, that rules change all the time, don't they? And you know, you think you're doing the right thing in one moment, and then all of a sudden the tax rules are changing and something else happens. One of the kind of things that people have been asking me over kind of recent times is what changes there might be in terms of taxation in the US or the UK that we might need to think about. There's been lots of noise in both jurisdictions about capital gains tax rises. Are they going to do it? Aren't they going to do it? You know, there's been comments even about saying they're going to bring it in line with income tax rates, or perhaps somewhere in between. Do either of you want to comment on the likelihood of something like that happening in the near term, medium term, or what else might be going on?
Brian, go for it.
Oh, I've always figured I'm going to tackle the question you didn't answer or ask, and then I'll answer the question. Because to me, just as often right now, especially this last year, we've been talking about them finally correcting estate taxes. And I say correcting it and giving us more of a long-term direction on how to manage estate taxes in the United States. And yeah, it's just become this huge battle in Congress of whether it's going to go down to 5 million or 3.5 million, or stay up in that 12 million area that we're at and continue to grow. I've spent 20 years of my career always predicting, oh, well, if anybody asked me, when would I rather pay my tax, when I'm living or when I'm dead? I'd say when I'm dead. I've been completely wrong, because it's gone from 1 million all the way up to 12 million. And so I'm the wrong person to ask about these political debates when it comes to taxes. That being said, we've also spent the last 20 years being around 100 to 105% debt to GDP. And here we are in most developed countries, including the US and the UK, where, except for Germany and Australia are the two exceptions, most every developed country has about 130% debt to GDP. So we're a lot higher than we have in the past because of the pandemic. And I don't think this crisis in Ukraine, where we have hyperinflation, is going to help any in that mix. That being said, there's only 3 ways to really fix an overly indebted country. One of them is to reduce their expenses, one's to raise taxes, and the other way is to inflate your way out of it. We're getting some major inflation here, but it's almost too much. You know, we're in this Goldilocks type of temperament where all of a sudden we're looking at Jay Powell today raising rates, which means if we get enough of that, that should slow down the economy. And therefore we're continuously in that, which means we might need to either cut expenses or raise taxes. Inevitably, at some point in time, I would expect some of that raising of taxes to be in course for us both in the UK and the US. And the easy ones to pick on are those investments and the estate taxes, because, well, there's more people that don't own stocks than do own stocks, sadly. Nathan and I, we're doing our best to try to change that going forward. Estate taxes are always an easy place to pick on.
Not quite as eloquent, but yes, I totally agree. Absolutely. It's my gut feeling is I don't have a crystal ball, but with everything that's happening and everything that's been happening over the pandemic, and then we've got the Ukraine issue as well, there's got to be some ways of doing it. And as you said, the options available are sort of threefold, and it's going to be a mixture of all of them to try and cope with everything. And I think taxes are going to be increased at some point.
Well, given these decisions on tax rates and rules and things are based on governments, Cam, should we put up our final poll and see who's actually registered to vote?
Are we voting early? Oh, we should have added and which state so that we could lobby those people.
And if anybody's got final questions to ask, do add them to the question and answer, and we'll try and have a look through those in our final moments here to pick off some of these final questions.
Oh, we've got a fellow Floridian. I'm also registered in Florida, just so that I can piss off everybody in the room when I tell them how I vote.
There we are. So quite a lot of people.
We got to get that changed over.
Yeah.
Hey, Cam, in the follow-up, do you want to add our YouTube video on how you register to vote from abroad? We have a nice video on our YouTube channel. Sorry, Nathan, I'm stealing that for a little more important ad on there.
Well, if you're having to do all this hard work and pay taxes, you should at least use your vote, right? So yeah, no, very, very good.
Let them. The more we vote from abroad, the more we get a say, especially when it comes to residency-based taxation and those types of issues. Because if they know that we're voting, they know that we can swing those some of those votes.
Yeah, a lot of people just don't know how to register, how to vote. So I think it's a really good idea.
Absolutely. We've got some good friends in those areas, and if there's interest, so drop us a line. If there's interest, we'll do some more webinars with some of our friends that are involved in those organizations.
Okay, I'm going to start looking through some of these final questions, but Brian, Helena, is there any kind of key points that you think we haven't told people about so far that we should mention before people start to wind up? Yeah,
there is so much to cover. As you probably guessed, there's bad news out there. To every yin, there's a yang, and there's things that can be done. There's if you have the right people advising you, then there's always things that can be done. And as the three of us know, there's the client in the middle, and then you've got tax and IFAs and wealth management. And it is a balancing exercise between everything. Nothing's totally perfect, and there are ways around things. If we're given enough time to maybe just look at an issue and look at a problem and plan ahead, then that's fine. If you're in the middle of an issue with the IRS or something, then that can be sorted out too. It's only tax, it's only wealth management, and people go, oh my God. But it's not like, we're not talking life and death, and there are experts around that can help. I can talk about all sorts of stuff, but I think that's probably the crux of it, really.
Okay, good. Right, I'm going to do some quick fire questions here. Bitcoin or cryptocurrency or whatever version you have, is that taxable?
Well, the IRS has actually got a question on the return now. Have you sold cryptocurrency this year? And it's on the right on the front as well. So yes, you do need to bear that in mind.
Okay, very good. Brian, can you hold such cryptocurrencies in an IRA? Is there a way of buying it in a pension account that you're aware of?
You can't buy direct crypto at this point in time, but you can buy indirect. There's some exchange traded funds that mimic what they're doing. And then otherwise, you can actually buy them as private placements to where it's a company that owns them. Do I suggest doing so? No, because to me, what we know about cryptos is they're not investment vehicles, they're trading vehicles. And if you have a trading vehicle, you can make a lot of money or you can lose a lot of money from them. And therefore, having them in a taxable account instead of a tax deferred account gives you the ability that if you really mess up and you lose money on that, at least you can offset it. You can use those losses against other gains. So I would not be considering a trading mechanism inside of a retirement account, because your retirement account is just for that, your conservative retirement money.
Well, I think I always kind of relate that also to the fact that the FCA is quite skeptical of cryptocurrency being an investment. So if you want to do it, that's fine, but perhaps don't think of it as a long-term investment. It's a short-term trade or a bit of fun. Yes, money can be made. You can make money betting on the horses as well. So let's.
Was that an invitation? Are we going down to the horse races?
Yeah,
It looks like you're already. There we are. Okay, next question here. What is the best way to hold foreign property? I know that if I jointly own it with my spouse, we need to report exchange rate gains on the mortgage. But if I put the entire thing in his name and 1% in my name, what's the position there? Well, this sounds like something we're going to have to do a whole another webinar on, isn't it? The ownership of property and things like that. But any short answer on that from either?
I think actually the next one planned. You have some people in your office that are going to be helping us on that matter in 3 months.
Yeah. So
absolutely, it depends on the size of the property and the time that you're going to be owning it, because. Effectively, if it's there might be opportunities where you might say, hey, let's go ahead and have this large asset in the non-American's name and not in the American's name. There might be other times where you might hear me say, hey, wait a second, between the two of you, if you make more than $500,000 of gains in the US, even if it's partially fictional because of the movement of the pound to the dollar, you've also made $500,000, and therefore, you know, say if you're buying a couple £100,000 house, if you make $500,000 on there and you owe a little bit of US tax, you should be celebrating instead of commiserating that you paid a little bit of US tax. So I think it depends on the size, the scope, the longevity that you're going to own it, and the actual balance sheet between you and your spouse.
Yeah, a lot of people, and that's really, really good point. Again, it's a matter of proportion, isn't it? But a lot of people have been told maybe if they get a big year-end bonus, and the best thing to do is pay down that mortgage. And then I go and tell them they've got a tax because they paid down that mortgage. They're not happy with me. Not very popular at all, because the exchange, IRS works in dollars. And if you've got a mortgage over here, more than likely it's going to be in sterling. So let's pretend round figures from my little simple brain here. So if you take out £100,000 mortgage, the exchange rate is 1.5. It's $150,000. If when you pay it back with that bonus and the exchange rate is 1.3, it's $130,000. So the IRS will say, so you took out 150, but you paid back 130. So you've actually made a $20,000 gain. And that, my friend, is taxable at ordinary rates. Even worse than that, if it can get worse, folks, is if you make an exchange rate loss, that is non-deductible. So it's heads we win, tails you lose for the IRS on that. So again, just be careful. If you're a US person, if you even think about sneezing on a financial basis, take advice first.
Yeah, no, I'm going to be looking forward to us running that pension webinar later in the year. I think there's a whole load we can talk about that. In the dying moments here, try and squeeze in a couple of more questions. We spoke about ISAs earlier. Question here is, how is investing in an ISA going to be better than just doing it in a regular investment account if you are a US taxable person? It's a fine line and a marginal benefit, but Helena, do you want to take that question, or Brian?
It's again, it's proportion, as Brian was saying, it's a proportion of the overall spread of the investment, really, isn't it? So Brian was talking about maybe using an ISA to have more aggressive just stocks and shares, so that you get capital gains treatment in both countries, and you get a capital gains allowance in the UK, but you spread that with other investments as well that aren't quite as aggressive, so you're spreading the risk overall without incurring PFIC issues. That's basically, I think, what that's all about, isn't it?
Absolutely. And beyond that, if somebody is not over that capital gains allowance that you're talking about, well, you're not going to be paying the 20% tax because you're under the capital gains tax allowance, and therefore putting it in the GIA makes it so that it's nicely diversified. You have the exchange traded funds and you don't have to worry about it. If you have a high net worth individual that's well over that capital gains tax allowance, now all of a sudden you might have a portfolio with 30 or 40 stocks inside of the ISA, and instead of paying the 20% on capital gains here in the UK, you might be in the 5 or 15% tax bracket on capital gains in the United States. So it doesn't avoid all the taxes like it would for a non-American, but it reduces those taxes, i.e., is it perfect for every situation? Absolutely not. We probably tell more people not to do an ISA when they're Americans than we tell people to do an ISA, but it doesn't mean that you can't have the tool.
Also, thinking about actual practicalities sometimes, again, not letting tax tails wag the doggers, etc. Especially when it comes to an ISA, when we've spoken about, you can only invest in individual stocks here, can't you? You can't invest in any ETFs or funds or anything. So if you're going to be drip feeding your investments, a few £100 a month or something like that, it's going to be extremely costly to build a diversified portfolio in your ISA in that way. So you'll be better off doing that into one of these dual registered and tax-friendly funds for both the UK and the US in your regular account. And then in the ISA, you perhaps want to do bigger lump sums. And quite often I talk to people about, save up, and then at the end of the UK tax year, do 20,000 at the end of the tax year, 20,000 at the beginning of the tax year. You can got £40,000 to fund your initial stocks portfolio in your ISA. That can be a lot more cost efficient from a trading perspective. So here we are. We've got 2 or 3 weeks for you to get your first 20,000 in, and then do the next lot in April if you have got that in mind. But that's one strategy that we use.
For the newbies on here that are newer to the UK, we're not talking about a January 1st to December 31st tax year. You might want to remind them that we end on April 5th.
Indeed, yeah. So that we've got different tax years here in the UK than in the US, and there's a play between the two there, isn't there? Indeed.
Absolutely. See, one of the things that we like to remind all of our clients is that sometimes our job is to first create a tax problem, and then we'll go to fix it, instead of just worried about the tax. If we create a tax problem for any of our clients, that means that we're doing a wonderful job, and then
my job is to keep you out of the tax problems if I possibly can.
Absolutely.
Go around them. Actually, one quick tip. Have we got time for a quick tip?
We've got a quick time for a quick tip here. Yes, please.
Right. Okay. So we're talking about April 5 versus December 31 year end, right? So right now we are in the 2022 calendar year, or the 21-22 fiscal year for the UK. So the tax return and the tax due for the 21-22 fiscal year is due by January 31, 2023. I hope you're all keeping up here. So for foreign tax credit purposes, on the US return, you get it, and you're on the paid basis, which most people are, to be fair, you will get a credit for any UK tax that you have paid during that calendar year. So the UK tax is due January 31, 2023. If you pay it that year, if you pay it during January, you will not get your foreign tax credit on your 22 return, where most of your income is going to be. You will get it on your 2023 return. So most people try and pay their tax by December 31. And what that does, it tries to match as much as possible the income that's being taxed on the US return. Now, there is a lot of wiggle room because the UK tax rates are higher than America's. If you've been here for a long while, it doesn't matter. But if you haven't been around in the UK for a while or living out of the US for a long time, then that's something to bear in mind. And if you pay it in December 31, and you don't use it, you can still carry it forward to the next year anyway. So there's nothing really lost there.
It's a brilliant tip.
Thank you, Sarah.
Very good. Well, I think we'll start to wrap it up here then as we round on the hour. If we've not answered your question, or if you have more questions, please do reach out to any of us, and we'll look to either answer it for you or point you in the direction of which of us are best to answer it for you. Please do look out for our future webinars, and of course, if there's any specific topics that you do want us to cover, then let us know and we'll try our best to put something together. Thank you very much from me, and thank you, Brian and Helena, for your comments and time.
Thanks so much for having us.
Thank you, Nathan. Cheers.
See you.
Bye.